also share the screen. Right. So looking at Euro AUD in reference to the trading sessions from yesterday, right? So we can see that today price continued with the downtrend, right? Price continued with the downtrend. So from a higher time point of view, you can see on the weekly, yes, we are supposed to be bullish on this pair. That's high versus low interest rates. We're supposed to be bullish. But the fact that dollar is not bearish anymore, you see, dollar has turned bullish for the past, I think, almost 10 weeks. Dollar has been on a bullish uptrend. So that now inversely affect Euro AUD because dollar is being bullish, so high versus we are looking for price to go to the downside, and you can see it's bearish, right? So when we go to the lower time frame and you are day trading, you're going to be looking for trades that are in relation to your higher time frame bias, which is shorting, opportunities. So in reference to the trading sessions from yesterday, you can see what happened once the daily candle of yesterday closed. So the daily candle of yesterday closed right there. That's the close of yesterday. Let me just put Control Y there. And the green candle. Opened. And then the green candle is the open. But can you see where the market, what the market did when it opened? The market traded to the downside. What was it doing during the first hour? It was just rebalancing this. You see, this candle here, the green candle, the first hourly candle of Thursday, price traded lower. It was rebalancing. You can see we've got inefficiency there. We've got that fair value gap, inefficiency there, and then we've got a bullish order block on H1 there. Though we're not going to focus on the bullish order block because we're looking for price to go lower, right? So
it was what? We called it. You say it was what?
Rebalancing the market. Yeah, you see we've got gaps here.
Yes.
These three bullish candles here, there's a gap there. You see? That's imbalance, right? That's inefficiency. So market will be drawn to inefficiency to rebalance the price action, right? Once it did that, market went to the upside during the Asian session. It created a high. 3 a.m. market created a high, and then it expanded to the downside all the way up until 8 a.m. That's the market telling you that it wants to go lower.
No.
Okay. Let me just grab this here. You see this expansion here? It happened during the Asian session and the London open session. So market expanded. When it expanded, it left a what? An order block. Right? Left a bearish order block. Remember, this is day trading. So you're going to be getting in these trades and looking to harvest, say, between 20 and 60 pips, and you're out of that trade. It's a day trade. You don't stay long in that position. So the expansion that happened during Asian session was the market giving us a signal that it wants to go lower. Market wants to go lower. Then at 11 a.m., London opened. Price came into fair value. You see, liquidity void, fair value, and then market continued going to the downside. If we look at the calendar, I don't know if there was, I'm sure there's something, there was CPI or something for Eurozone. Let me just go to the calendar quickly. Eurozone, 9 a.m., then 11, see 11:20 there with Italian 10-year BTP auction. We also had ECB bulletin. We also had these people from ECB speaking. So these people talking here affected the euro in a negative way against AUD. And you can see price was in fair value for shorting opportunities. Our higher time frame bias, market looking to go to the downside. So on H1, we've got this inefficiency. If you go to H4, you can see this green candle here that fills up the imbalance, and then market continued going to the downside. So when you look at the Asian session in reference to what is it that you're going to do the following day, the Asian session should show you expansions to where the market is actually going. Then this retracement here, basically that's our distribution. You see, that's market redistributing for a further move to the downside. So even if you go on lower time frames, you see that market was just rebalancing in fair value for it to continue going to the downside. So this is redistribution, 46 pips redistribution, and then it expanded close to 90 pips. Same thing would have happened on pound AUD, which is your pair, Daniel. Is it? Same thing would have happened. You can see
right.
during a
connect a laptop kababa. Check it outside when you the phone.
Okay. So
thank you.
During Asian session, you can see here, market expanded again to the downside. And what did it leave? It left an order block. You see? Firstly, an order block that is accompanied by a fair value gap. That's high probability. You see? So the moment you wake up, you've got this price action here, right? Let me just mark it out. So our fair value gap from here.
And then you have an idea of the trend that is going down on the downside.
Yeah, because these, you see, 1, 2, those big bearish candles, these ones here, would have happened 3 a.m., 4 a.m. We are fast asleep during that time. Unless if you're wide awake, you'll be seeing it happening. But when you wake up 6 a.m., 7 a.m., when you wake up, then you get to see that, okay, there's emphasis. Market has expanded during the Asian session. So where is the right time for me to get into the market? What is the right place? You'd have been waiting for the retracement, the redistribution, professional accumulation and distribution. You'd have been waiting for redistribution for market to continue to go to the downside. So once you see this imbalance here, this fair value, these gaps here, you'd know that already during London Open or sometime towards New York session, market is going to rebalance this price action before it continues again going to the downside, because our higher time frame bias market is going lower. You see, our higher time frame bias market is going to the downside. So whatever happens during the Asian session, during the London session, should give you a reference point here. Would see how do you approach the market. Say you want to trade the New York session. You just don't open the computer and then you blindly say, okay, no, I'm gonna look to short this pair or go long on this pair. You have a reference point on what is it that you are looking to do. So continuing with tomorrow, but tomorrow is Friday now, which is the last day of the last trading day of September. It's going to be a bit difficult to follow through with this assignment. So you can only do this probably next week, Tuesday. Once we have Monday's price action, then you highlight your trading sessions for Monday. Then you see how price reacts now on Tuesday to what has happened in the previous sessions. So it's very important when you're day trading to know what has happened during Asian session, during London Open and New York Open. By the time we get to New York close, you can't be day trading heading into New York close because already market is approaching the dead zone. You see, market is approaching a period where there's going to be less volume. So you can't be day trading towards New York close unless if it's a day when there's like FOMC or we've got Federal Reserve on the calendar late during the day. Yes, of course, you're not supposed to trade FOMC, But if you are a high risk trader, yes, days like FOMC towards New York close, market is going to be volatile. It's going to be moving up and down. So trading sessions are very important in the fact they give you emphasis on what to do in the next session. They give you reference point. You see, like where price is right now on pound AUD on this hourly chart, it's not going to break this level that easy. You see, it's not going to break those levels that easy. It has already broken this old low from yesterday's low has been broken. No, yesterday's low is still intact. So yeah, price could actually keep going to the downside, targeting the liquidity below the old low of yesterday. So price today is still inside yesterday's range, which is high and low. Price isn't broken above or broken below, but the price action that we have right now, price is likely to break below yesterday's low. You see, that's how you have to interpret the price action in reference to your trading sessions. So now we're going to continue with our day trading concept. And this time we're going to be looking at the central bank dealers range. I don't know if you have any questions in regards to the trading sessions.
The question is such. Let me do screenshot quickly ndokutumira mongori analyze penenda seta matrades angu kuti pandarasika ndepapo because ina kusvika kwandaifungidzwa kuti inosvika.
Which currency pair is that?
Euro AUD.
Okay, Euro AUD.
Yeah, ndiko kutumira screenshot quick one ndatoita screenshot screenshots.
Let's see.
Let's see. Was targeted fair value. Wait, I'm saying I was only targeting a specific fair value gap.
Now I want to see. I want to see now is
ndokutsvaga screenshot acho awandisa not this one.
Which time frame are we talking about? Maybe you can look at it from my side.
Okay. And then H4.
H4.
Yeah.
Where was your target? You shorting, right?
Yes, I was shorting. Sorry. So, and then I saw sell limit yangu pa 165,275.
1.65
275.
275. Yeah, price
Yes.
I now seek. Price I now seek. Price I now seek. Somewhere here. 1.6275. Right there.
Yes. Saka
75. Okay. H1. Right. Okay, you were anticipating the gap to be filled, right?
yes.
Okay, and that did not happen. Now, there's one thing you have to understand, guys. Like in relation to the PDRs, right? The premium and discount RS. When you have a fair value gap, for instance, in this case here, you see, when you have a fair value gap, the same thing that we have equilibrium on a bearish OB, right? Say for example, this is our bearish order block, right? Right there. That's our bearish order block. Now, the 50%, the midpoint of the order block, we refer to that as the equilibrium point. You see, 50% lower, 50% higher. The same thing applies on a fair value gap. Once you mark your fair value gap, like for instance, this gap here, which we had during Asian session, it's got an equilibrium point, which is right there.
Yeah.
So the equilibrium point, either of a bearish order block or bullish order block or a fair value gap, the equilibrium point is your optimum entry, whether you are selling or buying. because price will likely reach equilibrium before it finds, say, support or resistance.
Okay.
Like in this example, on the bearish order block from yesterday, price did reach the equilibrium point of the OB, and then it kept on going up and up, but eventually it dropped. Here on the fair value gap, price did trade through the equilibrium point of the fair value gap, but it could not fill up the gap. This does happen, you see, and especially if you are using limit orders, you are going to get instances where your order is not filled because of that.
Okay.
So if you are doing, say, instant market execution, right? Once you see price reaching equilibrium point of a fair value gap, you execute a less risk trade, meaning you are using, say, a smaller lot size, right?
Yes.
In anticipation of saying, what if it keeps on going up and up and up and up? You see, you risk less. Once the gap is filled, then you execute another position. Like for instance here, once price reached the equilibrium point of the fair value gap, you'd have gone, say, maybe with 0.5. You're shorting with 0.5, right? Lot size. If price did fill up the gap until 1.65 275, then you execute another 0.5, meaning you now have a standard lot size position in anticipation for a drop. So
Okay.
so when you're doing your limit orders, like I can see your screenshot now, that limit order that you have at 65275, it should have
Yes.
actually been anywhere below 1.65134. Then your order would have been filled.
Good. Okay.
Yeah, then your order would have been filled. In the case of that limit order there, you might as well just cancel it, because price, I don't think it's gonna, even if it comes back there now, it might keep going up and up and up. Yeah.
Okay.
Yeah. Now that's good, eh? That is a good setup. It was a good setup, only that price did not fill up your order. It was a good setup for shorting opportunity.
Okay.
Yeah.
I don't know about it. I'm a loss, because you know this thing so well.
Yeah, malosi anoitika. Unoziva malosi atinoita inini ka? Malosi andinoita manje Daniel ndeyekuti mapositions andinovhura manje. Mapositions andinovhura ka. Ndinenge ndavhura kana kuti ne 1 standard lot size, 2 standard lot size. Ndikangoona zvakupfuura 500 basi, I don't hesitate. A loss here 500 and above, I don't hesitate. I'll close the trade. Even ndikazoenda in my direction. But anything above 500, I close that position. And it happens. You see, it happens in a way. Let me give you an example, right? Let me give you an example. You see Aussie dollar, the current price action on Australian. No, let's go to New Zealand dollar. I think that's the one. Right. You see the current price action on NZD, right? We talked about this yesterday, Alec. You see that bearish order block there? You see this one? A position from equilibrium, you see, which is a shorting. A position from equilibrium here. Yes. It means with, say, a 1 standard lot size, this trade went almost $100 negative, you see, because there's 10 pips above the equilibrium point. It would have still been in my risk management. But anything above, say, 50 pips above, or say, no, 10 pips, 10 times, yeah, $10, yeah, that's 100. So anything above, say, 50 pips above this equilibrium point here, I'm closing that position, because chances are very high that market is still gonna go up and up and up. If market moves 50 pips above the equilibrium point of this order block here, if it keeps going up 50 pips, then chances are very high that market is going up. So if I go in with a standard lot size position, I'm not going to hesitate. I'm going to close that position, irrespective that market might eventually come down. But I cannot hold a losing position of say $700 or $1,000. I'd rather get out and look for another position which is going to give me maybe 25 pips or 30 pips to cover that loss.
Okay.
Yeah. Aiwa, tinonyura mdara, tinombonyura mumarket. But nyaya iripo manje, it's all about risk management. Standard lot size, 2 standard lot size, that's $20 a pip. You can get $200-300 almost every single day. Because an entry at this order block here on NZD USD, right? A short position with 2 standard lot size, you only need 10 pips to the downside, which is like somewhere there, somewhere here, and you're already holding $200. You see? And that happens almost every single day. So meaning if you can do like $200, $300, $200, $300 for like 5, 6, 10 days, then eventually you're going to get a loss. You can't keep holding a loss that you can cover with the gains that you have been doing for the past, say, 7 days.
Okay.
Yeah. So we continue with our day trading concept. Specifically now we are looking at central bank dealers range. Now, if you remember correctly, on Tuesday, I was like, guys, you must know that this market is manipulated. There is huge manipulation in the Forex industry because main reason is that it's not centralized. It's centralized, I mean. It's unlike crypto, which is decentralized. The Forex market, the main liquidity providers, they are centralized. So when we talk of the dealers range, right? A dealer's range in terms of our time, our sessions, you're looking at the period between 8 p.m. to 2 a.m. Remember that period which we say the dead zone.
Yes.
8 p.m. to 2 a.m. That's the time period that defines what we refer to as the central bank dealers range. Now, the central bank dealers range, ideally, you need the range. Okay, let me put my daily dividers there. So we're going to go 8 a.m. Now, let me use a major pair because these cross pairs here, they move like crazy. Control Y. So I'm on Euro USD. So 8 p.m. we're starting from here. Right, that's 8 p.m. Let me change this. Let me put a red line there. Daniel, tinotombonyurawo. Tinotombonyurawo.
Profits akawanda pane kunyura.
Aiwa. Profits anenge akawanda. Ndo pane pachida risk management. So 8 p.m. right until 2 a.m. So the high and the low between 8 p.m. and 2 a.m. every single day. Yeah, so that's 9. And I'm going to boys. As this is every day, you know it or so. No, it's something you do. Okay, from 8 until 2 p.m. 2 a.m. 8 p.m. until 2 a.m. That's the dealer's range. Now, what is a dealer, right? That is the main question. A dealer is a person responsible for the pricing of an asset. So that's 8. Then we've got yesterday. I just need to mark these 3 to give you guys an example. We've got yesterday, 8 p.m. until 2 a.m. right? So we've got the high to the low. That's the range. So that's what we refer to as the dealer's range. Now, with the session, Asian session, London session, New York session, right? There's people responsible for the pricing of an asset. Let's say Euro USD, right? The liquidity providers have got people that are responsible for the pricing of an asset. Now, someone from Asian session, say for example from Goldman Sachs or JP Morgan, right? That person is going to hand over the trades to a guy during London session. Then the guy from London session hands over the liquidity or the positions that they are holding to the guy in the New York session. Now, every day now, there's the dealer's range, right? Now, this is where they reprice the asset in determining where is the order flow, where is the highest order flow, where is the highest liquidity of an asset. If there's more liquidity to the upside, market will look to trade in that direction before it goes lower. If there's more liquidity to the downside, market will look to trade to that direction before it goes higher, right? So the central bank dealer's range, we use the range in determining the high of the day or the low of the day. The high of the day when market is bearish, the low of the day when market is bullish, right? So we've got Euro USD, right? Obviously, this currency pair has been bearish for the past 10 weeks. So ideally, the central bank dealer's range, you need it to be 40 pips maximum. The range must not exceed 40 pips, preferably 20 to 30 pips in total. Ranges that are larger than 30, 40 pips, they don't really give proper analysis in terms of your projection for the high of the day or the low of the day. The range in pips can be calibrated between the high and the low of the range. Alternatively, you can also use just the bodies of the candles. You can see the ranges that I've highlighted there. Let's start with the first one. Okay, I'm going to get rid of these two red lines. Let's start with the first one. So you can see from the high to the low of this range here, we've got 13 pips. You see, that range is too small. You see, you need at least between 20 to 30 pips. You see, when you look at the second range, you see, so already this morning I would have looked at this central bank dealer's range. Then I would have seen that it's only like 13 pips. It's not going to be of any use to me for my day trades. Then I move on. Then we've got yesterday's, not yesterday, the day before yesterday, the range was also 15 pips. You see, not useful for you to determine the high or the low of the day. Then you get yesterday's central bank dealer's range, right? You can see there 31 pips from high to low during the central bank dealer's range. We've got 31 pips. Now, this is what is important now. This is a central bank dealer's range that you can use to determine the high of the day or the low of the day. Now, for an asset which is bearish, you're looking for market to create the high of the day before you can entertain selling opportunities. For an asset which is bullish, you wait for the market to create the low of the day before you can start entertaining long trades. Now, how then do you project, say, the high of the day is going to come preferably here. Now, this is where we have the deviations. So with the central bank dealers range, right, we've got what we call standard deviations, right? So if a central bank dealers range is between 20 and 30 pips, right, most sell days, the market is going to create the high of the day with a maximum of 3 standard deviations. What are deviations? This is basically you grabbing the what? The range and mirror image. So this is 2 standard deviations. You see, those 30 pips of the central bank dealers range, you just grab the rectangle and you deviate on your price action. You can see here, 2 standard deviations, market created a high. Once you see market creating a high with 2 standard deviations or 3 standard deviations, that high there should have a reference point of discount of premium array if market is bearish, of a premium array for you to sell the market. Because two or three deviations, market is not going to keep going to the upside. It's going to find resistance when market is bearish. 2 or 3 deviations to the downside now. If market is bullish, 2 or 3 deviations to the downside, that's where market creates the low of the day, or D. Then you're looking for market price to trade into discount for it to go to the upside. So with these deviations, most sell days, once you have 2 or 3 standard deviations of your central bank dealers range, we've got one here from yesterday on Euro USD. We deviated 2 times to the upside and we traded into an area which most probably has got this premium array. Let me go to H4 right there. Right here. You see, we've got a bearish order block right there. You see? So I'm going to go back now to H1. Day trading, we are using H1. After 2 standard deviations, market reached an H4 bearish order block. See? And then market is starting to come to the downside. And you can see from the equilibrium point of the order block, from the equilibrium point of the order block, market dropped 20 pips. One standard lot size, that's $200 in 2 hours. So when you're talking of the central bank dealers range, yes, it's something which is a bit, what can I say? It's a bit advanced and it takes time to combine it when you're day trading. It takes time. That's why you need to have 2 or 3 currency pairs that you look at, because you're not going to trade 7 currency pairs, because it means you need to be looking at central bank dealers range of each and every pair. So if you're following, say, Euro USD, your trade would have only came about right now, like around 7, because Euro USD is bearish. So all this move to the upside, you wouldn't have entertained it. It's just a redistribution. Market redistributing and rebalancing this move here from yesterday. The expansion from yesterday, market is rebalancing that. That's distribution for another push to the downside. And if you're day trading and market gives you anything between 20 and 30 pips, that's more than enough. You're not going to hold for market to give you 120 or 300 pips on a single day. That's not going to happen. You see, it's not going to happen. So the central bank dealers range 8 p.m. until 2 a.m. Once you have a dealer's range that is ideal between 20 and 30 pips, once you have a dealer's range that is ideal 20 to 30 pips, then you can be in a position to project your high of the day between 2 and 3 standard deviations. Now, these standard deviations is just the range, the CBDR. If it's 20 pips, you do 20 pips staked up on each other, so that you're looking at, say, between 40 and 60 pips for market to find resistance before it goes lower. If market is bullish, between 40 and 60 pips to the downside for market to create the low of the day before it goes to the upside. You see? So ideal sell days, right? 2 standard deviations. That's your ideal sell days. When you see market having, say, 3 or 4 standard deviations, there's a change. There's probably a change in market structure. Market might keep going to the upside during your sell days, or during your buy days, you see 3 or 4 deviations to the downside. Market might keep going lower. So you don't want to trade when you have, say, 4 standard deviations. So ideal sell days, anything between 1 and 2 standard deviations. Ideal buy days, anything between 1 and 2 standard deviations to the downside. So you need to understand that your higher time frame bias is very important. You see, your higher time frame bias is very important. The moment you have a wrong directional bias on an asset, day trading can be very deadly. You'll be blowing accounts. So you need to understand. That's why I started you guys with short-term trading, then swing trading before we did day trade. You see. So your assignment for today, on your current pace, we're going to continue with market profiles tomorrow, because I need to go somewhere now at 9 p.m. On your current pace, pound AUD for Daniel, Euro AUD. Yeah, I know, Daniel, you are quite busy at work, but
yes.
Yeah, I know you are very busy at work, but try to, just try to practice these things here. For example, you see, yesterday's dealer's range on pound AUD. So that's 8 p.m. until 2 a.m. right there, right? So I'm just gonna do this. Then eventually I need to get rid of the lines so that I can see the high and the low, right? So the high and the low is on one candle. See, this range is gonna be too big. You see, that range is almost like 54 pips. You see, the range is too big. If we go to Euro AUD, 8 a.m. until 2 a.m. That's Euro AUD. Let me just put this here and get rid of the red lines so that I can see the wicks. See that I can see the wicks, right? See, you see, the range is also too big. Now, the reason why these two current pairs, the ranges are too big, these are minor pairs. See, minor pairs, they've got a bigger pip range. You can get one hourly candle moving 200 pips on Euro AUD. So for your assignment, both of you, you're going to use USD CHF, right? You're going to use USD CHF, right? So I'm going to give you an example of what you have to look out for. So this is 8 p.m. yesterday and 2 a.m. right there, right? So the range from yesterday on CHF was 27 pips. You see, on majors, it does work. So USD CHF, what is our higher time frame directional bias on USD CHF?
Higher time frame directional bias.
Yeah. If Euro is bearish, remember, if Euro is bearish, it means USD CHF is bullish. Remember, dollar has been bearish for the past 10 weeks, right? That's bullish, right? For the past 10 weeks, dollar is bullish. So USD CHF is also bullish. Look at the weekly chart. That's a bullish currency pair. Even if you go to the monthly, you see, that's a bullish monthly chart. Even if you go to daily, that's bullish. Market is just creating higher highs, higher lows, higher highs. It just keeps on going up. So when you go to our hourly chart, we need to be looking for what? For longs, right? So if we have a central bank dealers range that is 20, how many pips here? 20, 28, 27 pips. We need to project it to the downside, you see? To the downside, 2 standard deviations. High probability buy days. These are our ideal buy days. Market creates a low between up until the 2 standard deviations. Market creates the low of the day when it trades into discount for you to be a buyer. And you can see there, we just fell short for the low of the day. We just fell short for market to create the low of the day based on our deviations. We just fell short. Now, do we have any discount area that we can give reference to? No, we don't have. We just have this old low here from yesterday. Market traded below the old low and moved to the upside. Remember, old low and old highs, those are arrays. See, an old low discount array when market is bullish. An old high premium array when market is bearish. So you can see price traded below yesterday's low, close above, market went up. So basically a run of stop below yesterday's low. Yeah, this here is really not a bullish orb. Yeah, we've got one here right there. Though price did not reach for it, you see, this bullish order block here. Price did not reach for it, but it did come closer. It would have been a missed opportunity. But with the way dollar has been rallying to the upside, anything closer to this discount array and with your 2 standard deviations on an ideal day for long entries, there, that's 20 pips on USD CHF. So you're going to do the same for your assignment. You're going to do the same on USD CHF, right? Using 8 p.m., which is our current candle right now, this candle here, up until 2 a.m. You can do this tomorrow morning when you wake up. Take note of how big of a range the central bank dealers range was. Yeah, it might be a big one. If Powell says something here, you see, Powell is coming at 10 o'clock. If Powell says something in reference to, say, inflation or interest rates, the central bank might be quite a huge one. So that's your assignment. Mark out the central bank dealers range on USD CHF. Then you also mark out your sessions. 2 a.m., your true daily range today on, so we've got 9. We still need a candle here. I think the 9, okay, this is 9, so 8 is this, right? So yeah. Okay, I've already done what I want you guys to do. So you need your central bank dealers range and then your true daily range, which is 2 a.m. until 9 p.m., right? That's your true daily range where you have the Asian session, London, New York open and close. Once you have the true daily range marked, then highlight your institutional order flow. Now, of course, here we are looking for long entries. We're looking for buy positions. So you need price to trade into discount. But do we have any discount arrays there? I leave that for you guys to analyze. So you've got two things that you have to do. Mark out your central bank dealers range, 8 p.m. to 2 a.m. Then your true daily range, which is I've already defined it here. 2 a.m. Yesterday 2 a.m. Today 2 a.m. until this current hour here, 9 p.m. That's our true daily range. In that price action there, we are going to have institutional order flow to give reference point to for us to be either buyers or sellers. Of course, we're going to be buyers because this is a bullish market. Do you understand that, guys?
Yeah.
Yes, and I've written it down.
Yeah. So just in a nutshell, Dan, it might look like there's a whole lot of things. It's just a few items. Your IT. It's only a few things that make up one decision. And these things are things which you can look at for like 2, 3, 4 minutes on the chart. You can look at everything that we have been discussing so far in week 4 for your day trade, your sessions, your time sessions, your trading sessions. You can look at those. It shouldn't take you more than 2, 3 minutes to be in a position to see that, oh, we've got a bearish order block that was formed during Asian session. You see? So when price comes to that, you see, even if you're a scalper, right? Even if you're going against the market, right? You can clearly see here, London open, there's a bearish order block. Market comes, fill up the imbalance. You scalp it, going to the downside. You see? It's that simple. Why do you have to scalp it? You see here, when the rebalancing, redistribution happened on USD CHF, 3:30, 4 o'clock, what did we have on the calendar? There, 2:30, 4 o'clock, with negative news for dollar. You see, pending home sales, they came out negative 7.1. That's bearish for dollar. Bearish for dollar. That's shorting opportunity. Nice shorting opportunity on USD CHF from a discount, from a premium array that was formed during London session, London Open. You see? So it's just a case of now linking up with the fundamentals and everything. Once you have your sessions highlighted and you pick out the order flow, premium and discount arrays that are there, then if the calendar allows you to trade, say, against the market, like for instance, today, market really went against the higher time frame, you see, because of this negative news here that we saw for the dollar. Though I have a feeling that Powell might reverse the whole thing. Powell might really take these currency pairs up, especially dollar. If you go to hourly chart, this move here, Powell might move the dollar to the upside. He might stick to his hawkish sentiments that he shared a week ago during FOMC. The Fed were very hawkish, meaning dollar is going to go to the upside. So let's see if he sticks to that. And if he does stick to that, then this whole move that happened today to the downside on dollar could be erased by 2 or 3 candles. Or by tomorrow, London Open, market would have erased all these losses that the dollar incurred today. So it's only a few things that you have to look at to come up to a decision. But it takes time now to really combine those small bits and pieces for you to make a decision to say, oh, okay, I'm going to sell here, or I'm going to buy here. Looking for 20, 30, or 40 pips. 2 standard lot size, you're out. 5 standard lot size. If you have got a 6-digit trading account, then you can go 5 standard lot size. You only need 10 pips to make $500. So, yeah, 5 standard lot size, that's $50 a pip most.
Out of interest sake, why is the dollar behaving against the norm, especially towards elections?
You see what's happening right now? Okay.
Fundamentals.
Right. Dollar has got, actually, you see, the way they approached fighting inflation, they've been very clever. So what's happening right now, from a higher time frame point of view, right, that's basically distribution. Market is distributing. Of course, we've already broken to the upside here. You can see we've got a bullish breaker on dollar. So we've got 1 day left. You see, we've got Friday, which is tomorrow. And if Friday does trade below, okay, what is the high? Let me just, yeah, you see now, this is the high here, this down candle here, that's where price is. If price trades below, then market could start going to the downside. But if it closes above 105.86, then this imbalance here, heading into the last quarter, market will look to fill up that imbalance. Then beginning of the new year, if we're up here, then we're going to see dollar crumbling. So the way the Fed approached fighting inflation, everyone was anticipating a soft landing. The moment we have soft landing, then dollar should start coming down. But now there's no reason for dollar to come down at this moment in time. They have to make the dollar expensive also because inflation has turned up a bit, you see, due to the fact of oil going up and up and up, people spending, you see. So they have to make the dollar a bit expensive. That means the Fed have to be hawkish in their statements by all means so that dollar goes up. So yeah, it's going against a bit of a higher time frame directional bias at this moment, and it might continue. So this gray shaded area here, you could see dollar fill up this imbalance here. You see this whole move from here. We could see dollar gain probably about 3.35% from current price before we start seeing any moves to the downside. Yeah. So yeah, that's I don't know if there's any other questions.
No, from my
None
side.
from my end.
All right, gentlemen, Murare Moshe. I'll try to upload this one here probably tomorrow morning. That's when I'm going to upload. If it happens today, yeah, to be a bit later, but I'll upload it.
Okay.
Yeah. All right, gentlemen, Murare Moshe.
All right.
Sharp, sharp.